Welcome to this explainer. Today, we are going to break down exactly how something as simple as valuing unsold goods can literally dictate a company's absolute success or total failure. Look, whether you're prepping for a major accounting exam, running your own small business, or just trying to decode how the financial world actually works, mastering inventory valuation, it's an absolute superpower. Okay, let's dive into this. Think about it for a second. How is it mathematically possible that just by changing the way you count the unsold boxes sitting in a warehouse, a company can completely alter its reported net profit for the entire year? Honestly, it sounds like magic. Or, maybe even fraud. But it's actually just the incredible mathematical power of inventory counting. If you misunderstand this, a business might actually think it's thriving right before it goes completely bankrupt. So, here is our roadmap for today. We'll be covering 1. What is inventory exactly? 2. The golden valuation rule. 3. Calculating the true cost. 4. Choosing a cost formula. 5. Periodic versus perpetual tracking. And finally, number 6. Profit impact and an exam recap. All right, part 1. What is inventory exactly? Let's lay the foundation by clearly defining these assets. A lot of people think inventory just means the finished boxes waiting on a store shelf, but it's actually way broader than that. Inventory includes assets held for sale in the ordinary course of business, sure, but it also includes items currently in the process of production, and even materials that are going to be consumed in the production of your goods and services. Now, there is a strict boundary here. We explicitly exclude things like machinery spares, servicing equipment, and standby equipment. Those are generally classified as fixed assets, not inventory, mostly because their use is irregular and they're tied to one specific machine. And this brilliantly illustrates the difference between different types of businesses. Let's use a bakery analogy. Say you run a trading concern, like a local convenience store that just buys prepackaged cupcakes and resells them. Well, your inventory is just those traded goods, plus maybe some wrapping paper and cartons you use at checkout. You're buying it in its existing form. But if you're a manufacturing concern, an actual bakery baking from scratch, your inventory is a whole different beast. You've got raw materials like flour and sugar. You've got work in progress, which is literally the dough currently rising in the back. You've got finished goods, the freshly baked cakes. And you have stores and spares, like consumable baking liners. Moving right along to section 2, the golden valuation rule. We really need to establish the universal rule for assigning a dollar value to all these assets. Listen, if you remember absolutely nothing else from this entire explainer, remember this one sentence. Inventory should generally be valued at the lower of cost or net realizable value. This is the ultimate golden rule of inventory valuation. Why? Well, it's entirely governed by the principle of conservative accounting. Conservatism dictates that we should never, ever anticipate profits before they actually happen, but we absolutely must recognize anticipated losses immediately. So by forcing us to choose the lower number, accounting rules ensure a company never overstates its assets or its profits. So we generally know what cost is, but what exactly is net realizable value, or NRV? Simply put, NRV is what you actually expect to pocket at the end of the day. It's your estimated selling price minus the costs to finish the product, minus the costs necessary to actually make the sale. Let's say you can sell a cake for $10, but you have to spend $2 on icing to finish it and $1 on a delivery fee to get it to the customer. Your NRV is $7. Now, if that cake originally cost you $8 to make, the golden rule says you must value it at the lower number, that $7 NRV, meaning you take a $1 loss on the books immediately. Okay, part 3, calculating the true cost. What's really fascinating here is figuring out what exactly goes into the cost side of our golden rule. Because guess what? It is not just the price tag on your invoice. To get the true historical cost, we actually need to know what to leave out. I love using this little memory trick, WASS. This is going to help you instantly remember the 4 costs that must be excluded from your inventory valuation. W is for abnormal waste of materials or labor. If someone accidentally drops a whole 50-pound sack of flour, that inefficiency shouldn't inflate the value of your remaining inventory on the shelf. A is for admin overheads. Paying your HR manager's salary doesn't bring the inventory to its present location or condition. The first S is for storage costs. And the final S is for selling and distribution costs. Now pay really close attention here, because this is a massive exam trap. We just said in our WAS trick that storage costs are excluded, but There is a giant exception. Storage costs are excluded unless they are absolutely necessary in the production process prior to a further production stage. Think about it. What if you're making fine wine or aging gourmet cheese? Storing it in a climate-controlled cellar for 2 years is a mandatory part of the actual production. In that very specific case, those storage costs are absolutely included in the inventory cost. Section 4. Choosing a cost formula. With the rules set on what goes into the cost, let's explore the mechanical formulas used to calculate these historical costs across potentially thousands of items. The method you choose entirely depends on whether your items are interchangeable. If you sell highly unique, non-interchangeable, super expensive items, we're talking custom diamond jewelry or heavy medical equipment, you use the specific identification method. You track the exact cost of that specific machine. But if you sell thousands of identical, interchangeable items like AA batteries or bags of flour, tracking individual units is literally impossible. For those, we have to rely on average formulas. One of the most straightforward approaches is the simple average price method, and the logical flow is exactly as it sounds. Step 1, you just add all the different purchase prices together for a given period. Step 2, you divide that by the total number of different prices to get a single, flat average rate. Step 3, you value your closing inventory using this newly ascertained rate. It completely eliminates the headache of trying to figure out if the battery you just sold came from the January shipment or the February shipment. Which brings us to Section 5, periodic versus perpetual tracking. The crucial point here is how frequently a business is actually calculating these averages. So you have the periodic system and the perpetual system. Under the periodic system, you basically wait until the end of the month or even the end of the year, take a physical count of what's left, lump all your purchases together, and calculate one big average rate. It's definitely easier, but you're kind of flying blind during the month. Now, under the perpetual system, you are constantly updating. Every single time a new delivery truck backs up and unloads, the math is instantly recalculated to form a brand new average. This requires solid software for sure, but it gives you a real-time, highly accurate picture of your inventory costs. Let's look at a quick, simplified periodic calculation just to show you the math. On December 4th, we bought 900 units at a rate of 50. Then on December 10th, prices jumped up, and we bought 400 units at a rate of 55. Under a periodic average, we just look at the total cost, which is $67,000, and we divide it by the total quantity, 1,300. This gives us a mathematically determined final average rate of 51.53. So any stock remaining on the shelves at the end of the year will be valued at that precise 51.53 rate. All right, the final stretch, Section 6, Profit Impact and Exam Recap. Let's see how all this math actually hits the bottom line for your final exam and, honestly, for real-world business survival. It all boils down to the cost of goods sold, or COGS formula. Cost of goods sold equals opening inventory plus purchases plus direct expenses minus closing inventory. I want you to really notice that minus sign. Because closing inventory is subtracted in the COGS formula, it has a massive direct manipulation on your final reported profit. Think about it. If you assign a higher value to your closing inventory, you are subtracting a bigger number from your costs, and lower costs mean higher reported profits. Because of that tiny minus sign in the formula, we arrive at this brilliant rule of thumb that you absolutely must memorize. Closing inventory and net income always move in the exact same direction. If your closing inventory is overstated, meaning, oops, you accidentally valued it way too high, your net income will also be overstated. If your closing inventory is understated, your net income is understated. It is a direct, undeniable mathematical link. Let's wrap this all together and lock it into your memory right now. Remember the golden rule. Always, always value at the lower of cost or net realizable value to satisfy the principle of conservatism. Remember your WSS trick to exclude abnormal waste, admin, storage, and selling costs from your valuation. And finally, remember that whatever happens to your closing inventory figure happens directly to your net profit. As you can see, inventory isn't just about counting dusty boxes, it's literally the financial engine of a business. In fact, studies explicitly show that poor inventory management and valuation is a leading reason small businesses are forced to shut their doors for good. If you overvalue your stock, you might end up paying real cash taxes on fake profits that don't actually exist. If you undervalue it, you might make terrible pricing decisions. So I'm going to leave you with this to think about. If you run a business or you're auditing one, do you truly know what those unsold boxes are worth? Because your survival depends on it. Thanks for joining this explainer, and we'll see you next time.
Welcome to this explainer. Grab your magnifying glass, because today we're stepping into the shoes of the inventory detective. We are going to solve one of the ultimate mysteries in accounting, figuring out what a company's inventory is truly worth. Getting this right is absolutely crucial. Think about it. If a shoe store doesn't actually know what the boxes of shoes in their back room are worth, they have zero idea if they made a real profit this year. Getting it wrong can literally lead to disastrous financial reporting. But don't worry, by the end of this explainer, you'll have completely cracked the valuation code and be fully equipped to ace your exams.
Here's our case file for today. First, inventory basics and formulas. Then, non-historical cost methods, physical time adjustments, consignment and abnormal items, FIFO versus weighted average. And we'll wrap it all up with a rapid-fire final exam recap. Let's get right into it. Section 1. Inventory basics. Foundations and formulas. So, what exactly is inventory? You might think it's just finished boxes sitting on a warehouse shelf waiting for a buyer. But actually, the definition is way broader than that. If you're a furniture maker, your inventory is the raw wood you just bought. It's the half-built chairs sitting in your workshop, what we call work in process, and of course, the finished tables ready to sell. It even includes consumable supplies waiting to be used up. But here's a massive tip for your exams. It normally excludes machinery spares. Why? Because those spare parts are for long-term use in the factory. They aren't meant for immediate sale or consumption, so they belong under property, plant, and equipment. Remember that distinction. Now, to figure out how inventory actually impacts the bottom line, we have to calculate the cost of goods sold. And I've got a super simple memory trick for you here. Just remember the letters OPDC. Opening inventory plus purchases plus direct expenses minus closing inventory. The logic here is totally straightforward. You start with what you already had in the warehouse, you add what you just bought and what it cost to get it ready, and then you subtract whatever didn't sell. Why do we subtract closing inventory? Because those boxes are still sitting right there in the warehouse at year end. If they are still there, you didn't sell them, so they can't be part of your cost of goods sold. Whatever is left over after that calculation is the true cost of what you actually sold. OPDC, write that down because it is heavily tested. Moving on to Section 2, Non-Historical Cost, Alternative Valuation. First up, how do businesses actually keep track of all this stuff? There are two main ways. The periodic system is like, imagine a tiny corner shop that literally locks its doors, suspends operations for a whole weekend once a year, and physically counts every single candy bar. That's periodic. The perpetual system? Think Amazon. Scanners, barcodes, and continuous real-time tracking of every single item coming and going. Management knows exactly what's there every single day. But here's the catch with the periodic system. Because it forces a business to completely halt operations, they usually can't afford to do it exactly on the last day of the financial year. And that creates a really interesting timing puzzle that we're going to solve in just a few minutes. Normally, when we value inventory, we use historical cost methods, things like FIFO or weighted average. But sometimes that's just not practical, so we use non-historical methods instead. For instance, the standard cost method. This is perfect for industries where prices are constantly and wildly fluctuating, like crude oil. Instead of chasing every single chaotic price swing, they just set a predetermined standard cost. Makes life way easier. Then you have the adjusted selling price method, which is also known as the retail method. Why do we need this? Well, imagine running a massive supermarket with 50,000 different products. Trying to track the exact historical cost of every individual apple or box of cereal is basically impossible. So they use this adjusted retail method instead. Let's actually see that adjusted selling price method in action. It's kind of like magic. Imagine a store knows its total sales for the year were 200,000 rupees. They do a quick physical count and see they have 50,000 rupees worth of inventory left. But wait, that 50,000 is measured at the retail selling price, not what they paid for it. So how on earth do we find the true cost? We use the gross margin. The total selling price of all the goods they had available was the 200,000 they sold plus the 50,000 they didn't sell. That's 250,000 total. We know the cost to buy all those goods originally was 200,000, which means the gross margin, the profit, is 50,000 rupees. Now 50,000 divided by the total sales value of 250,000, that gives us a flat 20% profit margin. So to find our closing inventory cost, we just strip that 20% profit margin right out of the 50,000 retail inventory. Boom! It reveals the true cost, 40,000 rupees. Seriously, it's accounting magic. Section 3, Time Adjustment, Physical Inventory. All right, detectives, remember how the periodic system forces a business to shut down to count? Well, what happens if the financial year ends on December 31st,
but they couldn't get around to counting the warehouse until January 7th. We have to do a backward reconciliation. I want you to picture a time machine. You are standing in the warehouse on January 7th, and you need to time travel back to December 31st. Step 1. Start with the value you just counted on the 7th. Now, step 2. Walk backward. Any inventory you sold during those first 7 days of January, well, it must have been sitting in the warehouse on New Year's Eve, right? So you have to add it back to your count. Step 3. Subtract any new purchases made during those 7 days, because obviously they were not there on December 31st. This simple 4-step time travel logic is a massive favorite on exams, so definitely keep it in your back pocket.
Section 4. Consignment and abnormal items. Solving the mystery.
Here is where things get a little tricky. The golden rule for inventory is all about legal title. Valuation follows legal title, not physical possession. Let's look at consignment. That's when you send goods to an agent to sell for you. It's like lending your bicycle to a friend so they can sell it at a flea market. Your friend physically has the bike, sure, but you still own it. You hold the legal title. Then there's goods on approval. This is basically a physical free trial. You give a customer an item, and they have the option to return it within a certain time frame. In both of these cases, the absolute critical rule you must remember is this. You retain legal title until the final sale is confirmed. So those items must be included in your inventory valuation, even if they aren't physically in your building.
Now let's tackle a huge trap where students constantly lose marks on exams: abnormal items. Things like water-damaged goods. If you're trying to use a standard gross profit percentage to find your cost of goods sold, you absolutely have to isolate and remove any abnormal items from your opening inventory and your sales first. Why? Because normal goods sell at a normal profit margin. A water-damaged, crushed box does not. If you mix the damaged goods in with the pristine ones, your gross profit calculation for the entire warehouse is going to be completely skewed. So, be the detective. Separate the abnormal from the normal right at the start. Exclude the written-off abnormal book value, like that 32,500 rupees right there. Only then can you calculate a clean, accurate closing inventory of 62,500 rupees. Always, always separate the abnormal goods first.
Section 5. FIFO and weighted average ledger card methods.
Let's break down the first-in, first-out method, commonly known as FIFO. We'll use a hypothetical company, Sriram Mills. FIFO assumes the oldest inventory is sold first. Think about a grocery store stocking milk. They always push the oldest milk to the front to be sold first, right? So on February 20th, Sriram Mills needs to issue 100 units. If we look at their balance from the 15th, they had a mixed batch: 50 older units that cost 30 rupees each, and 150 newer units that cost 40 rupees each. Under FIFO, they take those 50 oldest units at 30 rupees first. But they still need 50 more units to hit that 100 mark. So they dip into the newer batch, taking 50 of the 40 rupee units. What does that leave us with? Exactly 50 of the newest 40 rupee units in the final balance. That gives us a closing inventory valuation of 2,000 rupees. The big takeaway here is that with FIFO, the inventory sitting on your balance sheet always reflects the most recent market prices.
Now contrast that with the weighted average method. This paints a completely different picture. We don't care about old versus new units here. Every single time a new purchase is made, we blend the cost together into one smooth average. So how did we arrive at exactly 38 rupees here? Well, they had 50 units at 30 rupees, and they bought 200 new units at 40 rupees. You take the total combined monetary cost of all 250 items, divide it by 250 units, and boom, you get a new, perfectly blended average rate of 38 rupees per unit. So later, when they issue 100 units on the 20th, they use that 38 rupee rate, leaving 50 units remaining at 38 rupees for a final valuation of 1,900. Think about that for a second. The exact same physical boxes are in the warehouse, but they have a completely different financial value simply because of the accounting method we chose.
Section 6. Final exam recap. Test your reflexes. All right, time to put your detective skills to the test. Read this first question carefully. True or false? Abnormal amounts of wasted materials, labor, or other production overheads are included in the costs of inventories. Take a split second. Think about it. Do we include abnormal waste? And the answer is false. You only ever include costs that bring the inventory to its present location and condition. Abnormal waste? That's an inefficiency. It is a loss for the current period. It's definitely not a valuable asset that you can just tuck away in a warehouse and sell later for profit. Never, ever include abnormal costs in your inventory valuation.
Let's hit a foundational multiple choice question. Inventory is disclosed in financial statements under A, fixed assets, B, current assets, or C, current liabilities. Think way back to the very first definition of inventory we talked about today. If you said B, current assets, you nailed it. Remember the core definition? Inventory is an asset held for sale in the ordinary course of business. It's current because the business fully expects to sell it and convert it into cash within the next 12 months.
Okay, last question, and this one's a bit of a trick to test how well you know your accounting standards. Accounting standards do not permit which method of inventory valuation: A, FIFO, B, average cost, or C, LIFO. The correct answer is C, LIFO, which stands for last in, first out. While you might learn about it in theory, modern accounting standards generally forbid it. Why? Because it can severely distort a company's profitability and leave incredibly outdated costs sitting on the balance sheet. Imagine a hardware store that's been using LIFO since 1980. Their balance sheet might say a standard hammer still costs $2. It completely distorts financial reality.
Before we close the case file today, let's do a quick mental recap of everything you've mastered. You know the OPDC formula inside and out: opening plus purchases plus direct expenses minus closing. You know how to time travel using backward reconciliation. You understand that legal title dictates consignment rules. And you absolutely know why abnormal goods have to be separated first. And that brings us to the ultimate overarching rule of all inventory valuation. Inventory is valued at cost or net realizable value, whichever is less. If your inventory loses value, you have to drop its value on the books immediately. This is the principle of conservatism, and it's there to stop companies from artificially inflating their assets. But I'll leave you with this thought. In our world of rapidly advancing technology, where brand new electronics become completely obsolete in a matter of months, how much phantom inventory value do you think is secretly hiding on the balance sheets of massive tech giants right now? Something to think about. Thanks so much for joining me for this explainer, and keep on learning.